Hey guys, it's Michael here, and today we're going to talk about the Barefoot Investor and index funds, or more specifically, Scott Pape, the author of the Barefoot Investor, and his thoughts on index funds. But for those of you who aren't familiar with the Barefoot Investor, well, it's one of the most popular personal finance books in Australia. In fact, right now it's currently the #1 best-selling book in personal finance on Amazon. And the Barefoot Investor is now one of Australia's most trusted finance experts, frequently speaking on national TV to provide advice to everyday Australians. And in a nutshell, the Barefoot Investor book is a no BS guide to taking control of your personal finances with very simple and practical steps that all Aussies can follow. And I'll leave a link to the book in the description if you want to check it out for yourself. And in this video, we're going to dive into the various index fund portfolios that the Barefoot Investor has constructed and recommended over the years. But in saying that, one of the main lessons that Scott shares in the book is to automate your retirement planning by investing in index funds. And on investing, he actually used to run a paid newsletter called the Barefoot Blueprint, where he shared a lot of stock and ETF recommendations. He even shared some index fund portfolios in that newsletter, which is what we'll be discussing today. However, unlike the Barefoot Blueprint, I provide all of my content here on YouTube for free and will never ask you to pay. And all I ask you to do is smash that like button down below and subscribe if you want to continue to see more. And just quickly before we go into the Barefoot Investor Index Funds, an index fund is just a simple way to invest in a large collection of stocks. An index fund might have thousands of different individual stocks in it, but you only ever have to make one purchase to own a portion of all of them. And in a world without index funds, if you want to have the 1,000 different stocks in your portfolio, you'd have to actually purchase every single one individually. And if you're paying $10 per trade in brokerage, that's going to quickly add up over time. So using an index fund is just a way simpler way to manage a portfolio of thousands of different companies. You don't have to worry about constantly rebalancing the weightings each day. And the best feature of an index fund is in its very name, and that's the fact that it passively tracks an index, which is just a set of investment instructions that the fund needs to abide by. So for example, with the ASX 200 index, that just means it's tracking the performance of the 200 largest companies listed on the ASX in Australia. And just as a side effect of using index funds, you get another major benefit, which is diversification. Because imagine if you only had 5 individual stocks in your stock portfolio and one of these went down and failed, you could end up losing a lot of money. Whereas on the other hand, if you go and buy the entire ASX 200 index fund, well then, like I said, you'll have 200 different companies that contribute to your overall return. So even if one of them failed, it doesn't really matter because you'd have the 199 other ones to boost you back up. Okay, now onto the juicy stuff and what you came for, which is the Barefoot Investor, and what he really thinks about index funds. Well, the best way to describe this would be confusing, and I don't say this lightly, and I'll explain what I mean now. On one hand, it's really clear that the Barefoot Investor is a fan of passive index funds and the benefits that they bring, as he brings them up in several sections of the book. For example, on page 141 of the Barefoot Investor, it reads, respected US financial research firm Dalbar has been tracking investors' real returns for decades. And here's the shocker, their research shows that the average investor earned 3.7% annually over the past 30 years during a period in which a basic index fund returned 11.1% annually. In other words, the average investor underperformed the market by approximately 7.4% each year for 3 decades. He even went to echo Warren Buffett's praise of the index fund a few pages earlier in the book, where he said, Warren Buffett, the world's greatest investor, is leaving his wife her entire inheritance in a simple index fund that automatically buys the 500 largest companies in America. We're talking about companies like Apple, Google, Facebook, McDonald's, Amazon, and Nike. My Super does the same thing, but it's also got the 200 biggest Aussie companies like banks, Telstra, and BHP. And on that note about Super, the very superannuation fund that Pape recommends is the Index Balanced Fund from Host Plus, which is an index fund superannuation option. So from these sections in the book, among many others, It's clear, like I said, that the Barefoot Investor understands that for the everyday Australian, which is the target of his book, will benefit the most from using low-cost, passively managed index funds. But this is where it gets a little bit spicy and somewhat confusing, because in the section in his book about specifically investing outside of your superannuation, the Barefoot Investor doesn't recommend a passive index fund. Instead, he recommended an actively managed LIC on the ASX. And an LIC, for those of you who don't know, just stands for Listed Investment Company. And this is the quote from the book. "My recommendation for your first investment would be the Australian Foundation Investment Company, AFIC." And what really confused me even further was until just recently, the Barefoot Investor used to run that newsletter that I mentioned, the Barefoot Blueprint, which had an annual fee of a few $100s. And in that Barefoot Blueprint, he would share individual stock tips to his followers, which we just established would significantly underperform an index fund based on that quote from the Barefoot Investor that I shared earlier. Now, thankfully in 2019, he did shut down the Barefoot Blueprint newsletter. And before he did share some index fund portfolio strategies, which is what we're going to get into now. The original Barefoot Investor index fund portfolio that he shared in that private newsletter was called the Break-Free Portfolio, with the premise of it being easy to manage, hence the name. It consisted of 5 ETFs, which he suggested to rebalance once a year to keep to the recommended percentage allocations, and each ETF was in a specific sector. So the first sector that he recommended was Australian large caps, and he recommended using the ETF called STW, run by State Street, which tracks the ASX 200. And its objective is to capture potential stock growth opportunities, dividends, and franking credits from the largest 200 companies in Australia. And it has a management fee of 0.13%, and has returned over 8% per annum since inception over 20 years ago. And the Barefoot Investor recommends having an allocation of 35% in STW, as he tends to prefer Australian equity allocations, with large caps from the ASX 200 being the most stable with a decent dividend yield. The next ETF the Barefoot Investor recommends as part of this portfolio is VSO, which is run by Vanguard and tracks the MSCI Australian Shares Small Cap Index. And its objective is to provide diversified exposure to small companies listed on the ASX. It has a management fee of 0.3% per annum, and since inception in 2011 has returned just over 7.5% per annum. And the Barefoot Investor recommends having an allocation of 15% of your portfolio in VSO in order to really just diversify your concentrated Australian equity holdings between large caps and small caps, which is probably the right move. But at this point, with over 50% in just the ASX and Australian equity holdings, it does feel a little bit concentrated. And now, continuing on with that Australian theme, the next ETF he recommended having in this portfolio is VAP, another Vanguard ETF which tracks the S&P ASX 300 AREIT index, which has an objective to invest in property securities on the ASX to provide exposure to primarily commercial real estate. It has a management fee of 0.23% and has returned over 11% per annum since inception in 2010. The Barefoot Investor recommends having an allocation of 20% in VAP in order to get exposure to the Australian property sector. And at this point, we have over 70% of our portfolio just focused in Australia. But in the first ETF with exposure outside the ASX, the Break-Free Index Fund portfolio recommends a 20% exposure to IOO from BlackRock. And this fund's aim is to provide investors with the performance of the S&P Global 100 index. And this index is designed to measure the performance of 100 multinational blue chip companies of major global importance. IOO has a management fee of 0.4% per annum, and since inception in 2018 has returned just over 4% per annum. However, just important to note here that the actual index that this ETF is tracking has been around a lot longer than just 2018, and over the past 10 years has returned over 16% per annum. The recommendation is to have a 20% allocation of your index fund portfolio into IOO, and this is frankly a much needed change to the overexposure into Australia, and in my opinion probably could be a bit more. Finally, to cap off the break-free index fund portfolio, Pape recommends a 10% allocation into the VAF ETF from Vanguard, which tracks the performance of high quality Australian bonds. It has a management fee of 0.2%, and since inception in 2012 has returned over 4% per annum. And given the broad demographic of the readership of the Barefoot Investor, it really does make sense to have an allocation into fixed interest bonds just to reduce the overall volatility of the portfolio. So overall, the break-free index fund portfolio is definitely not a bad portfolio, but personally, I just think it's probably a bit too concentrated in its Australian exposure. In addition, the overall management fees are actually pretty high as well, and the recommended ETFs could definitely be simplified and swapped out for some lower cost alternatives, which I'll go into very shortly. But before we do, we should just look at the second index fund portfolio from the Barefoot Investor, which he put together just before shutting down his Barefoot Blueprint community. And this was named the Idiot Grandson Portfolio. The asset allocation strategy used a combination of ETFs that invest in Australian, international, and US shares. And the aim of the Idiot Grandson Portfolio was to be a permanent set and forget investment portfolio that would provide a steady stream of income in the form of dividends and growth that could be passed down through the generations and be simple enough for any idiot to manage. And to actually put this together, the Barefoot Investor analysed 201 ETFs and 114 LICs listed on the ASX to find the best investments to add. He used a 3-stage filtering process to reduce the 315 funds down to just 10 index funds for the Idiot Grandson portfolio. And the first step of this 3-stage filtering process was pretty straightforward and involved removing any funds that simply had a management fee of over 0.4% per annum. This really quickly reduced the amount of LICs down from 114 to just 10, and the number of ETFs from 201 to 60. Now, the second filter that the Barefoot Investor used here was to remove any funds that he considered undesirable. And this is obviously pretty subjective, but the definitions of undesirable that he used were: 1, any funds that were focused on purely small caps due to their higher than average volatility were removed. 2, funds that specialized in specific areas or strategies were removed as they weren't broad in nature. This included things like high yield dividend harvester type funds or thematic ETFs, which typically have pretty volatile returns since they're focused on very specific things. Third, any funds that involved using derivatives or synthetic in nature were removed, and this included any internally leveraged funds as well for obvious reasons. Fourth was any equal weight index funds were removed, as they don't track a market as closely as a market-weighted fund. And then finally, any industrial funds were removed as well, as they generally aren't tracking a broadly diversified index, which meant they weren't as simple and easy to manage, which is one of the premises of this portfolio. So after this second wave cut, the Barefoot Investor Index Fund portfolio was left with just 13 ETFs and 6 LICs. And then the third and final filtering process was actually even more subjective than the second one and involved looking at the management styles of the various remaining funds, and the Barefoot Investor chose to focus on funds that were purely non-for-profit. And this left the Idiot Grandson portfolio with just 10 funds remaining from 3 sectors that he was targeting, which was Australia, global, and US. The Australian funds were AFI, ARG, AUI, DUI, MLT, and VAS, a crowd favourite. The US funds were just VTS, and the global funds were VEU, VGAD, and VGS. And the allocations the Barefoot Investor recommended was 75% Australian stocks, 15% global stocks, and 10% into the US. And again, in my opinion, this was probably way too concentrated in Australian stocks. However, if you did want to follow the Barefoot Investor Index Fund portfolio, the lowest cost selections and simplest options from those ETFs would be 1, VAS, the Vanguard Australian Shares ETF, as 75%, VEU, Vanguard All World Excluding US Shares Index ETF at 15%, and VTS, the Vanguard US Total Market Shares Index ETF, at the 10%. But in my opinion, there's a much simpler and optimal way of constructing the Barefoot Investor index fund portfolio by using just 2 ETFs. This is through 1, the BetaShares A200 ETF at 25% allocation, and the Vanguard International Shares Fund, VGS, at 75% allocation, as this will give you 75% international and 25% Australian exposure, giving you really great diversification to Australian companies and their sweet franking credits, as well as exposure to the rest of the world. And there's no overlap, as VGS doesn't include Australian holdings. But if you want to know a bit more about this 2-fund portfolio, check out my video where I cover this and why it makes sense and what the benefits are. And if you're trying to construct one of these index fund portfolios, it can be a little bit annoying trying to keep it balanced, but there's actually a really simple way to automate this entire process and put this investing pretty much on autopilot. And that's by using this new stockbroker that I've been using called Pearler, which has this really unique auto invest feature that basically just allows you to configure predefined investment instructions, very much like an index fund, where you can say, I want to invest in A200 for 25% and VGS at 75%. You just set up a deposit schedule and it will literally take care of the rest and keep those funds balanced at your set allocations. If you do want to check out Pearler, I'll leave a link in the description below where you can get a free trade for signing up. And if you do want to know a bit more about Pearler before going and signing up, check out my comprehensive review on Pearler, where I go over all the different features, pros and cons that you should know about. In summary, my final thoughts on the Barefoot Investor index fund portfolios is that they have just a little bit too much exposure to Australia and are just slightly more complicated than they need to be. Personally, I prefer to keep it much more simple and as low cost as possible. And I think you can do that at the same time as getting just as good returns, if not better, than some of the index fund portfolios that the Barefoot Investor put together. So with that said, guys, thank you so much for watching the video. As always, smash that like button, subscribe, and hit that bell. And leave a comment if you've got any questions. I really do try and answer most of them. Have a great one, and I'll see you in the next video. Bye.